And a very warm welcome. Thank you for joining me today. Very interesting day in the markets. S&P and the Dow look like they're on the verge of breaking down. We'll get to those charts in a minute. And first, let's start with a quick review of the bond market. You can see the key area in the bond markets: the 2-year Treasuries, the 5-year Treasury. You know, the 5-year is really the critical area. It's leading the markets higher, and it's becoming very pronounced at this point. We did see yesterday we had a flat yield curve. Today it steepened just a hair, and so still I would consider this a flat yield curve. But we did see a little bit more movement in the 10-year treasuries today than we did in the 2 years, and we'll just have to see if that continues moving forward. Anyway, on to the next slide. And next slide, 3-month LIBOR bumped up just a tick today at 0.97%. 2-year Treasury yield unrelenting at 2.524%. Man, that was not much of a pullback, was it? Oh, goodness. Next chart. 5-year Treasuries. Again, not much of a pullback. We did not get the 38% pullback that we thought was possible. We didn't even get half of that, and now we've gone to new highs. So a clear signal that we are in all likelihood moving even higher. So we'll see what happens from here. Same story with the 10-year Treasury. You could see we had a little bit more pullback and haven't quite bounced quite as high on the 10-year, but it's awfully close between the 10 and the 2. The big story really is coming up here on the next chart on the 30-year Treasuries and the 30-year Treasury. We see that we have not gone to new highs yet. That's an interesting little sidebar. It'll be interesting to note, just kind of make a mental notation, that right now the 30-year Treasury yield is lagging to the upside. It's not an immediate issue in my opinion, but it is something to note as we get an ongoing rollout of Treasury yields. And it is interesting to note that we're starting to see a slowdown in the 30-year. Let's move to the next chart. Next chart, we go to the 30-year fixed rate mortgage, closed today at 5.02%, closed over 5% for the first time. Again, it's unrelenting. And I really don't see much relief in sight right now. But anyway, move on to the next chart. Here we have a Fed funds history. Interesting, this goes back to the 1950s. And the reason I pulled this up is that we are going to come up with a companion video either later tonight or tomorrow. And courtesy, I got permission to use some of the work from Dr. Edward Yardeni. I got his permission earlier today. Very exciting stuff, and we're going to be doing a video on the Taylor Rule. The Taylor Rule is from Dr. John Taylor, and he's an economist, very prominent economist at Stanford University. And it tells you, within a reason, where the Fed funds rate should be versus where it's at. And you'll be able to see that we are way behind the curve at playing catch up, and that's why the Fed realizes it, and that's why they're talking about 2 increases in the Fed funds rate, or a 50-point increase, 2 25-point increases, but a 50 basis point increase at the May 3rd and 4th meeting. So that's a big deal. Anyways, let's move on to the next. Okay, and moving on, we could see here the last 6-day chart on the Dow with the 5-minute bar chart, so a very short-term view of the markets, and we can see that we are testing last week's lows that we discussed last Thursday, and we've come right back down. We're revisiting, and it does look like we're going to break to new lows, which would take us considerably lower. We'll examine that here. I believe it's on the next chart. And here we go, yes. So the next chart you can see going up to the upper left-hand corner. Let me put the little clicker on here, a little laser. We can see right in here, going back to January. We had our high up here in January, coming back down to the first low. Second high, we have a lower high, lower low, again, lower high again. And it certainly does look like we're going to break, and if the pattern continues, and I expect it will, that we're going to break to a lower low. That would be my expectation. We'll see what the future brings, but I think that's a um, reasonable guess at this point. Looking at the S&P over the last 1 year, the one thing of note, and it's a minor issue, but you can see here that the S&P has gone above the previous high, whereas the Dow has not. Quite frankly, it's a very nuanced difference, and I don't think at the end of the day it's going to make a hill of beans difference, but that's just my opinion. So let's move on to the next chart. And moving to the next chart, we've got the shorter term 3-month on the hourly chart. Again, it does look like, if you break it down, you look down in this area, it looks like we are approaching last Thursday's lows. And I would expect a breakthrough to lower lows. I expect it tomorrow. May not happen until Thursday, but sometime in that time frame, I think, is a reasonable expectation. Let's move on to the GDP now. GDP now chart's interesting. We did have a downturn in the last couple of days. We were at 1.5%, came down to 1.4% estimates, and now we've declined into the 0.9% estimate. And let's go to the next chart, the next slide, I should say. And okay, and with GDP now, you can see the big issue, the drop that's occurred from 1.4% yesterday and had a 0.9% GDP growth for the first quarter. Today, that estimate dropped, and that's with ISM non-manufacturing index essentially taking a look at the change in net exports right here. That has worsened, and it's a problem. There's no way around it. It's a problem, and it leads back to oil exports, and well, excuse me, oil imports, and we need to rectify that situation. So we'll see what happens. Anyway, that's about it for now. I appreciate your tuning in, and I hope you have a wonderful day, and we'll talk to you again tomorrow. Bye-bye. Next chart.